I'm very excited about, what we'll be able to talk about today. There's a lot going on.
Mhm.
There really is. And so I do start off the show each week with a summary kind of what I saw happening in the market this week. And I guess we're going to call this tariff week, really, because that's what's been going on for the most part. That's most noteworthy, at least for the market standpoint. So let me see.
Oh,
Oh, didn't work. Okay. So we're having trouble with our connection here on our visual, but we'll just talk through it. So the stock market hit an all-time high yesterday.
mhm.
Right, again, came down on Monday based on the tariff talk that was going on over the weekend. You're going to start sending out letters to these countries. And on Monday, specifically the two biggest countries that I saw, 25% tariff letter went to South Korea and Japan,
Yeah.
right? So pretty major, partners. Now there's been, I don't know, maybe 20 different letters that have gone out altogether from anywhere from 20% to 40%. Not that far off so far from where we were on Liberation Day.
Yeah. Some have come down. Most have come down, but occasionally there few have been up a couple of percent.
Yeah, and we've got, a 50% tariff all of a sudden now on copper. It was announced this week, which is actually a really big deal, maybe a bigger deal than the 50% tariff
Mhm.
on steel and aluminum. You have, of course, the 50% tariff that's been threatened against Brazil, which is kind of a weird one because they actually they buy more from us than we buy from
Yeah,
them.
it's
So,
unusual for such a large tariff. It seems
yeah.
more punitive than actual for the trade deficit
Yeah, he's upset about the possible prosecution of the previous
administration.
administration, yeah. So, I guess the thing that's kinda interesting to me, right? We're re-announcing the tariffs
Mhm.
that came in April 2nd specifically, and it drove the market down nearly 20%, right? And today it was down like a quarter percent off of a new all-time high that we hit, yesterday, even though we're announcing all of these tariffs that came out. Why would the market be,
Mhm.
doing so well in a time frame where obviously, that concern was very acute
Mhm.
back in April. Here we are in July, just a few months later, and all of a sudden it's not that acute. So, really, the key piece, I think, the thing that's changed in that time frame is that Trump has backed off. As a matter of fact, these tariffs that were announced this week are sort of a back off in a way, also, because the ones that he paused from April 2nd were supposed to start up again on July 9th, which would
Mhm.
have been Wednesday,
Yeah.
right? And so that's been pushed out to August 1st. And so now he's, sending out these letters and announcing tariffs. And today actually talked about moving up the base tariff, which is 10% right now, to 15 to 20%. Um, so if you look, there's a thing called the Yale Budget Lab. They do a really good job, I think, of trying to put together the impacts of tariffs and all those types of things. So right now they're saying that the tariffs that have been announced and not just talked about, but announced um, uh, are an average 18% tariff
Yeah.
is where we're at right now. Okay, so if you look back to the height of the tariffs back in the 1930s, it was a 19.2% tariff. So we're getting there. I think if you go to a base tariff of 15 to 20% for every country, you're probably going to get up into that 19 to
Yeah.
20 plus percent average tariff. So, we have the same level of tariffs that we have back in the 1930s. And so, um, the Yale Budget Lab, made some projections. So first of all, one of the things they said, which I thought was interesting, over the 10-year period, the next 10 years, if the tariffs stayed the same, right, even with some demand destruction, they're projecting about $2.6 trillion worth of tariffs would be collected, right? So, we got that budget bill that came through that had about a $3.3 trillion deficit,
Mhm.
right? So theoretically, the tariffs could pay for most of that budget deficit. The problem with tariffs historically, especially at these levels, they've never been able to stay.
Yeah.
Because if you look at the impact of 1930s tariffs, unemployment doubled in 12 months. World trade literally collapsed. It went down two-thirds of a 66%. It dropped by 1933.
Yeah, I don't think world trade's gonna stop. I think just the U.S. may get excluded or isolated out from world trade. A lot of other countries are just looking for other partners to subsidize what would have been traded to America. You know, China's, has traded more this year than previous years,
That's right.
even though trade has dropped with the U.S.
Yeah, that's an interesting point. So if you look at May for China, the exports to the US dropped 43% this May versus the last May of last year. Yet China's overall exports grew 4.8% in May. So they're picking up the difference. I guess, if you look back at what happened before, you probably couldn't have the US doubling their unemployment rate and all these other things that would happen without having some global contagion. That's true with China or any of these big countries if they really start to have troubles financially. Um, and so I think part of what happened in that 1930s, trade collapse had to do a lot with just the overall economic situation that's happening there at the same time. And so but the Yale lab had some things that I thought were somewhat moderating in terms of their projections. So, for example, they're expecting the consumer price index to grow 1.9% if all tariffs are pushed through to the consumer, which is a pretty big if. It probably wouldn't be that. There'll be right now, what we've seen so far is 20% of the tariffs are being absorbed by the exporter.
Mhm.
So 80% is coming into the country to be split amongst the
Business.
businesses or consumers. Neither of which is great, right? I mean, so if the businesses paid all of it or some of it, they're going to have less money. They're going to hire less. They're going to do less projects, those types of things. If it goes through to the consumer, especially in a substantial way, they're going to buy less, right, and have less buying power.
Yeah, it depends on the categories.
Right.
Yale Labs is saying that clothing and shoes are going to go up almost 30%,
Yeah,
right?
exactly. So
So,
it is specific to different areas,
yeah,
right? I said in their autos would be 5 to 12.7%. The
food is 2.4.
2.4% was projection on food. The overall household would lose about $2,400 worth of buying power on average, and here in the US. And so I think what's interesting though, if you look, because they were talking about like the GDP for 2025 would drop about point 4 to point 0.5 to maybe a half a percent. Uh, again, if you look at where we were last year at 2.3 or whatever, we're still not in a recessionary basis based on their projections as far as that goes. You look at the overall scenario for um, what's happening. That price increase doesn't scare me as much as it might, right? I mean, we just had CPI go up to 9% in
Mhm.
2022. And so we're at, let's just say, for example, we're at 2.5% to make up a number. And if it goes up another 2%, we're at 4.5%. The market would struggle with that only because, it's going the wrong direction. And it means the Federal Reserve is not going to be lowering rates. And right now, part of the factoring that's coming in from this movement upward in the stock market is the fact that there is expectations for a couple of rate cuts this year, specifically starting in September is what the market's betting on right now. But if you start to see, and this is where we're going to probably see some volatility. If you start to see, that price increases coming up and we're going, away from 2.5 and all of a sudden we're at 3, so it would make a pretty big difference. It's not quite like what we saw in 2022, but the market has already factored in a couple rate cuts. If you go from a couple rate cuts to a couple rate increases, the market's going to have an adjustment to make from that standpoint. So you know, the thing that people are asking me the most is why is the market going up in the face of all these potential issues that are coming? Because potentially the deportation of immigrants could affect, agriculture, construction, the restaurant industry, the lodging industry, those types of things. That could create an inflationary impact. You could have an inflationary impact from this big, beautiful bill, actually, that's
Yep.
really would start more next year because that is money that's coming back into the consumers' hands and businesses' hands that could be spent, and so there's a lot of potential inflationary pressure. And so, why is the stock market going upward? Well, I think the biggest reason, there's a couple reasons, but there's a whole bunch of pieces that if you take a look. Number one, the people that are nervous about this have been out since April.
Yeah, most of the people just exit the market.
Yeah, that leaves the other side. So that's what happens when you see these, extreme pessimism surveys that we start to see in April. People are selling and getting out at that point in time, and are likely still sitting out because we haven't solved the tariff thing yet, right? So it's still out there. Uh, the other reason there is a seasonality that happens right now. The first half of July, if you go back to 1928 and look at the first half and second half of each month, the first half of July is the best 2-week
Hmm.
period, right? First half of a month. And that has to do with what they keep putting in the headline, a wall of money. You saw the same thing last year. A wall of money that comes into the market after the first half.
Hmm.
And it has to do with all of these big funds and pensions and what have you, invest in cash and rebalancing and those types of things. The average peak going back to 1928 was the 17th of July.
Yeah, and usually you have some softness afterwards for the beginning of fall.
Yeah, I mean, last year, the 16th of July was the top. We dropped, I don't know, 5 to 10% as I recall, into August. As far as that goes, it came down quite a bit. So it recovered from that and went on its way. Um, but you do have a lot of things coming together. You have that peak that's possible from that cash flow. You have seasonal softness that happens. September is the worst month of the year. It's really the only month going back that far that has an average rate of return that's negative. Um, and so you're kind of going into that. And now we're starting to maybe see the impacts of some of these, pieces. Right now, if you look at what the Yale Labs was talking about too, they were saying, okay, if you look from January through, May of this year, we're seeing about a 1.5 to 4.5% increase on kind of a basket of goods. If you annualize that out, you're looking at 3.5 to 10% increases. That's pretty substantial, so those things are gonna start to they're already going up so far just since, January through May, but that impact will continue to go, and it obviously doesn't include the, big tariffs that are supposedly gonna come on August 1st. So, the other reason the market could be going up is because the market does not believe that these tariffs are gonna stay here,
Hmm.
right? Because that and it's been going up ever since basically Trump did the pause. It was like a signal to the market. It's like, oh, if things get bad, he's going to go and make it better by changing it. And that's a big difference. In 1930, tariffs were passed by Congress, and they kept them in there. It was really hard to get rid of them, and it
Yeah, yeah,
really
yeah.
it it went on forever, because it's Congress. Here, it's Trump, and so he can decide to go up or down as far as that goes. So, there's I think that's a big chunk of what's happening here. I will say, for me personally, I'd be a little bit nervous just because nobody can tell. I'll never forget in 2008 with Greenspan and Paulson and the CEO of Lehman Brothers meeting, that picture is still in my mind. And they had just bailed out Bear Stearns with a $125 billion bailout. Lehman was asking for a $150 billion bailout. They were unhappy with the Lehman CEO, hasn't been following their advice. They didn't bail out Lehman, and we ended up with a 30% drop because what they didn't realize was that behind the scenes was $7 trillion worth of credit default swaps that had been sold in a 5-year period. So this is a private market. And so what's going on right now? So whether you think Trump's the smartest person or not, um, I think even the smartest person would have a really hard time knowing all of the mechanisms that are being pushed around right now.
Hmm.
And so these tariffs can kind of create that situation where something can fail and unexpected things can happen that you can't just then take the tariffs back. It'll be on its own. That cascade could start as far as that goes. I don't know that that's a high probability, but generally speaking, this is not an unusual occurrence. It's about a once every 20-year occurrence where we find out something is falling apart behind the scenes or is under pressure, private equity, private credit, all these things
Yeah.
that are happening. It can be very difficult to figure out what dollar amount's really out there and how that dollar amount is actually placed. And what type of risk might be available in that particular system. So uh, that's one piece. So the other piece is again, there was a pause this week from July 9th to August 1st. And yeah, we're throwing up all these big numbers, but Will they happen? Because one of the things to me, when you look at this week, Trump likes to do distraction things. If he
Yeah,
has something that's happening that he doesn't want everybody to focus on, he'll start doing something else that kind of sucks the oxygen out of the air. He's really good at it. And this week, of course, we had the Texas flood, which is a big deal, and then, of course, the Jeffrey Epstein file scenario that's being played out there. So there's two things that he might not want people to be talking about, and so he starts to go after these tariffs because it's very visible this week, very aggressive.
yeah, and a lot of the predictions were this week's tariffs would actually happen.
Yeah,
And so having an August 1st
mm,
deadline
right,
is just another extension of it. So
right.
people are feeling like he just keeps backing off and extending and extending.
That's right, and so does it even matter? That's what you can look at the market. I think the market says it doesn't matter. It doesn't matter that he's announcing all these tariffs because if he just keeps pushing the deadline back, they don't come into effect. And a matter of fact, they start to, have less impact on like Christmas, which is a big one. So when you get back to August 1st, a lot of companies are buying toys and different things along those lines. And so some of these things can really help if they continue to push that back. And so that's the game that's being played right now. The stock market is feeling fairly confident that, the tariffs that we're talking about, because again, they're the same tariffs we were talking about April 2nd that dropped the market 20% are now having almost no impact on the market.
Yeah, and that could be the risk adverse investors are out, and only people that are willing to take on risk are still in the market. So they're just
Yeah.
see it as, oh, it's okay.
Yeah, it's a very interesting time frame. You're trying to basically determine kind of the psychology of what's going on here and what not to. So, we have a 2/3, of our normal allocation exposure to the stock market. So we've been participating in this up movement kind of nicely. We still have that other third in kind of the T-bill area. In hindsight, we'd have been better off just being in there. But I still feel like there's enough red flags, there's enough question marks that need to be answered before we really go rolling out that direction. And let's see what those impacts are. I do believe that even the tariffs that are here now, because I mean we do have a 30% tariff on on China, 20% I think has been agreed upon with Vietnam. Got a base tariff at 10%. You know, there's
Canada is 35% now.
Yeah, that's right. Today was 35% announced. They did not announce, though, in that Canada bit, whether the USMCA, which is the old NAFTA agreement, which has currently been excluded, which has no tariff on those particular goods. Uh, so, you take the big travel hit that's happened, because the travel industry, the tourism here in the US is getting hit pretty hard. The confusion that all this is causing and the cutbacks that people are doing. And, it's kind of interesting because one thing that has happened is people have kind of accelerated some of the purchases. I met with clients this week that just bought two cars. They weren't going to buy them right now, but they decided to do that because they didn't want to deal with possible tariff increases that might come on that area. So there's in a way, the tariffs are creating, more commerce, at least here in the short term. And so I'd like to see, so let's say they were going to buy those cars next year or, later this year, and all these people are front loading their expenditures. That means there's possibly a gap coming at some point in time. So I think August, September, October going to be really interesting time frames to see how things go. It's a soft time of the year anyway,
Yeah.
and see if the market can hang in through that. I think that would be very instructional. So, anyway, that's where we're at right now. Thank you for joining us for our summary. I look forward to being able to do this again next week.